Welcome to this deep dive where we are in full Talk Tickers mode.
Yep.
And we are focusing on a company that just dropped, well, one of the most surprising earnings reports of the quarter, Quantum Computing Inc., or QUBT.
Oh, definitely.
Their Q3 2025 update came out after the bell on November 14th, and the market's reaction has left this huge question mark hanging over the company's strategy.
It really was a pivotal quarter, but you have to know where to look. We're going to look past those, glowing headlines about profit
Right.
and really dig into the quality of those numbers.
Yeah.
Because the real story here wasn't core growth. It was this massive, just unprecedented injection of cash.
A war chest.
A war chest, exactly.
Right.
And our mission today is to figure out the strategic game plan behind that kind of extreme liquidity.
Okay, so let's start with the numbers that got everyone excited. I mean, if you just glanced at the summary, QUBT delivered a knockout.
Absolutely.
On GAAP EPS, they reported a profit of a penny, 1 cent per share.
Which is wild.
Well, yeah, because the street was expecting a loss of 5, maybe 6 cents. So that's a positive surprise of what, over 115%?
A surprise profit from a quantum company at this stage it's just exceedingly rare.
And the revenue is just as strong, at least relative to what people were thinking. QUBT brought in just over $380,000.
So 0.384 million.
Right. And that number, it might seem small, but it's a 280% increase from the same quarter last year.
And more importantly, it crushed the consensus forecast.
By about 200%. The market was looking for maybe 0.12 million.
So the reaction was immediate and aggressive. It really confirms that the street loves a big beat.
Totally. The stock closed at 10.60 on the day of the news.
And then what happened?
It rallied 8.5% by the close of the next trading day. And the volume just spiked. We're talking 2-3 times the normal average daily activity.
So investors were clearly reacting to what they thought was a big shift in the company's financial story.
Okay, so let's unpack that. That 1 cent EPS, the 2.4 million in net income. Before we pop the champagne, we have to look behind the curtain.
We do.
Where did that profit actually come from? Because my read is that it didn't come from selling quantum systems.
You hit the nail on the head. I mean, the net income figure was almost entirely manufactured by non-operating gains.
Right.
If you look at the income statement, the core operating reality is still, well, it's still very much in the red. The whole thing was flipped by 2 huge non-core items.
Okay, walk us through those, especially for anyone who isn't, steeped in derivative accounting.
For sure. So the biggest contributor, number one, was a $9.2 million mark-to-market gain on derivative liabilities.
Which is not cash.
It is not cash. It's an accounting adjustment. So when the company issues things like warrants, changes in the stock price force them to adjust the value of that liability, which can create a non-cash gain.
And it was a big one this quarter.
Huge. And the second piece was $3.5 million in interest income, which they earned just by holding onto the massive pile of cash they just raised.
So if we strip away that one-time accounting gain and the interest they earned on their own capital raise, what does the core business actually look like?
It looks exactly like you'd expect a rapidly growing but still very early stage quantum tech company to look.
Meaning
Operating expenses soared. $10.5 million on the quarter, up from about $5.4 million last year.
So the operating loss was?
About $10.4 million. The core quantum business is still in a heavy cash burn mode.
Though, to be fair, there was one bright spot, the gross margin. It jumped up to 33% from just 9% a year ago.
It's meaningful progress, yeah.
Yeah.
Though management did caution that given the custom nature of their contracts, that number is going to be pretty volatile.
Sure.
But really, all of this just leads us back to the biggest story of the quarter, the balance sheet.
The war chest.
Exactly. Management created this just extraordinary liquidity position. It's designed to remove any and all near-term financial constraints.
And extraordinary is the word. They did a $500 million private placement in Q3.
And then another one.
And then another $750 million in October after the quarter closed. So if you look at the balance sheet on September 30th, they already had $813 million in cash.
Fold in the next raise. And QUBT now has access to over $1.5 billion in liquidity.
Think about that for a second. That scale it's almost absurd from a business metrics standpoint.
It really is. They're sitting on $1.5 billion in cash.
And their quarterly revenue is $384,000.
It's like having the budget to buy a fleet of corporate jets but your main business is still basically a lemonade stand.
It's an incredibly aggressive move, and it completely changes the conversation from, can QUBT survive, to how on earth will they deploy all this capital?
Precisely. It signals a shift from survival to an aggressive strategy focused on execution and market dominance.
So let's talk about that roadmap. With this $1.5 billion war chest, how is management framing their technology? They spend a lot of time on the call talking up their photonics-based quantum stack.
They're betting everything on photonics, on light-based systems. Their core message is all about practicality, accessibility.
Right. They're trying to differentiate from competitors who need those massive, super cold cryogenic systems.
Exactly. They keep emphasizing their room temperature operation, which gives them huge advantages in SWaP-C.
SWaP-C, that's size, weight, power, and cost. Can you just quickly explain why that room temperature approach using TFLN is such a big deal?
Absolutely. The tech they're leveraging is called thin film lithium niobate, or TFLN. It lets them cram these really complex photonic circuits onto a tiny, efficient chip.
So no giant refrigerators.
No giant refrigerators running near absolute zero. QUBT stuff works at room temperature. That massively shrinks the footprint, the power draw, and ultimately the cost. It's a pure play on making quantum infrastructure feasible, like right now.
And they did cite some pretty strong commercial wins to back this up. First, they're getting initial cloud-based revenue for their Dirac-3 system.
Yep, for optimization workloads, including noise reduction for NASA's LiDAR systems.
Which is cool, but the bigger validation point was definitely the cybersecurity order.
Oh, without a doubt. The first U.S. commercial quantum cybersecurity order from a top 5 bank.
That feels huge.
It is huge. It signals that big financial institutions are moving past just research. They're actually buying solutions to mitigate post-quantum cyber risk. They're worried about Shor's algorithm breaking today's encryption.
And QUBT is selling them a solution for that today. That puts them squarely in the financial services security space.
It does. And they also mentioned some other early work, like a collaboration with POET technologies for high-speed transceivers.
Which ties right into their TFLN manufacturing expertise.
And that's where the $1.5 billion is headed. Management gave some big updates on their facility in Tempe, Arizona, what they call Fab 1.
They said it's fully operational now, right?
Fully operational. For small batch manufacturing, for early customer programs, they've already got over 10 foundry service orders.
And what's critical is that they're almost done spending on it.
Right. The remaining CapEx for Fab 1 is tiny. Just $2 million for some specialized testing equipment.
So that means the immediate capacity issues are solved, and that $1.5 billion is all looking to the future.
Exactly. That money is being deployed toward Fab 2. They're already scoping the land, the build-out.
And this is for high-volume manufacturing.
High volume. The goal is hundreds of millions of chips per year. This capacity is for their own machines and for external foundry services for markets like telecom and sensing. It is an incredibly ambitious plan.
Okay, let's shift to the investor context. This is where you have to balance that enthusiasm with a bit of scrutiny. What are the forward-looking signals and what's missing?
The main missing piece is quantitative visibility. The company did not issue any precise revenue or EPS guidance.
Not at all. For the next quarter or with the full year?
Well, just qualitative stuff, continued revenue growth, margin improvement. For big investors, this means they have to, and this is the quote, underwrite execution rather than formal guidance.
That's a very specific piece of jargon. Can you break down what that actually means for our listeners?
It means you, the investor, you aren't betting on a specific forecast like we promise $5 million in revenue next quarter.
Okay.
Instead, you're forced to place your bet on management's ability to deliver on their big strategic goals.
Like signing the next bank or building Fab 2 on time.
Exactly. You're underwriting their capacity to execute this hyper-aggressive plan, not just their ability to hit a number.
And that puts a ton of pressure on management's credibility, especially since, some third-party commentary has pointed out some inconsistencies in their past narratives.
That is a legitimate point of friction.
Right.
For instance, earlier commentary suggested Fab 1 had capacity constraints holding them back, and now it's suddenly fully built out with just $2 million in minor capex left. Those kinds of shifting narratives can make investors a little wary.
Right. Why should we believe the plan for a multi-billion-dollar Fab 2 if the story about current capacity has already changed?
That's the question. But if we pull back and look at the whole sector, how are their peers doing?
Well, QUBT's non-core profit really stands out. You look at a peer like IonQ, They reported almost 40 million in revenue.
Wow.
But they still posted a net loss of over $1 billion because of R&D costs. D-Wave doubled their revenue, but they're also still deeply in the red.
It just highlights that the fundamental challenge for the whole quantum sector is getting to scalable commercial viability.
Which leaves QUBT with this
Yeah.
huge investor thesis dichotomy.
Absolutely. The company screens as this highly unusual, liquidity-rich, revenue-light platform.
The bull case versus the bear case.
The bull case rests entirely on converting those big-name pilots, the bank security deal, the NASA collaboration, and proving they can scale the TFLN foundry business.
And the bear case.
The bear case points to the limited visibility, the $10 million quarterly operating loss, and the huge dilution risk that's already hit the stock after these massive capital raises.
And we have to touch on one more thing before the trade idea. M&A. Management made that crystal clear on the call.
Oh yeah, the CFO explicitly said M&A evaluation is a key part of their strategy.
The goal being?
To acquire customers and revenue, and to fill technology gaps. I mean, that's not a subtle hint. That is a clear signal about how they plan to use a big chunk of that $1.5 billion.
All right. Let's move into the fun part of the deep dive. We've got this extremely volatile company, a jaw-dropping $1.5 billion cash hoard, and just $384,000 in quarterly revenue.
It's a setup that is just begging for aggressive speculation.
It really is.
So this is where we put on our speculative hats and acknowledge right up front, this is not financial advice.
Of course.
Given the bizarre balance sheet and management's explicit focus on M&A, we have to assume that $1.5 billion is not going to sit idle.
Right. It has to be deployed, and soon.
Aggressively and soon, or shareholders will start demanding it back.
So what's the outrageous but plausible trade?
The idea is a strategic M&A pair trade. You initiate a long position on QUBT common stock,
Okay.
paired with a short position on a smaller revenue-accretive photonics firm, or maybe a quantum services company that's in a niche security or telecom vertical, a firm that QUBT might target.
The logic being?
The logic is simple. The next major positive catalyst for this company will not be a press release about R&D. It'll be a large, bold, revenue-justifying acquisition announcement.
So you're betting the CEO solves the revenue light problem by buying a solution.
Exactly. That kind of deal would instantly create market excitement around the sheer scale of the new combined company. It provides immediate revenue and justifies all that capital they raised.
So the trade is a bet on external expansion, not a slow internal R&D burn.
You're betting on the immediate transformative power of the war chest. It's a highly aggressive play, but it's strategically logical given what the CFO said.
It is.
So, to recap this deep dive, QUBT delivered a headline profit that was, well, entirely accounting driven. It was masking a $10 million operating loss. But that maneuver allowed them to unveil the real story, this phenomenal liquidity position of over $1.5 billion.
And the focus now is all on execution.
All on execution. Scaling the manufacturing roadmap with Fab 1 and Fab 2, and more importantly, converting those high-profile pilots into real recurring business.
So given that aggressive focus on practical room temperature photonics for cybersecurity, what should you, the listener, be tracking as the ultimate measure of success? Will the true determinant of QUBT's long-term value be the speed at which that top 5 bank security pilot goes from being a single one-off order into a standardized recurring subscription model that they can sell across the entire financial sector?
That transition from pilot to subscription.
That's everything.
That's the metric we believe you should be watching closely. Thanks for joining us for this deep dive into Quantum Computing, Inc.
We'll catch you next time.